The really only big piece of news that's happened since October is the U.S. election. And so we took that on board and decided that we should incorporate some form of fiscal stimulus, since there seemed to be a fair bit of agreement around something. I don't know exactly what it's going to look like, but we've modeled it in a way which seems reasonable, at least to get us started on that discussion. And with that, we find when you look at the nuances of it, there's very small effect passing through to Canada. We have a backup in bond yields in the wake of the election, and that is affecting Canadian mortgage rates, 5-year mortgage rates, so far quite modest. And we have a stronger Canadian dollar measured in multilateral terms. But I think most importantly, what we have is heightened uncertainty about trade policies in particular. So with that package, we identify a number of downside risks as well as upside risks in our projection. But should any of those downside risks materialize and put our inflation target at risk, then we would have the room to maneuver. And so in the basic answer to your question, in that context, especially with inflation having been below target for a prolonged period, yes, a rate cut remains on the table. And it would remain on the table as long as those downside risks were still present.